Welcome to another edition of Taking Stock for the week ending the 24th of January 2025. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share markets. Great to have you on board, Jason. How was your holidays?
Holidays was pretty good, Ken. We sort of missed you last week. Hopefully you had a pretty good time off as well, and the family has been good over the holidays.
Yeah, I didn't really have a good time. I actually had COVID, but I'm glad the family didn't catch it. So that was the key. But before we get started, just a quick yet important reminder that the information we provided today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so past performance figures shouldn't be relied upon as a guide for future performance. Well, Jace, share markets were mixed this week with optimism around the US presidential Trump's inauguration and promises to cut corporate regulation and taxes. That was tempered by concerns over his tariff threats against China and the EU, which weighed on Australian mining stocks this week. And in the resources sector, though, Trump also plans to boost US oil and gas production and increase energy exports, which have pressured oil prices. And this isn't really a surprise given that the US is the largest producer of crude oil and accounts for around 12% of global crude supply. So the decline in oil prices has impacted one of our star borderline stocks, Woodside Petroleum, which
Mm.
released their fourth quarter production update. So, first off, did the update meet market expectations?
Well, Ken, it was a bit of a mixed bag coming from Woodside's end. I mean, on the production side, the company did produce 51.4 million barrels of oil, and this is slightly above the consensus expectations of 50 million barrels. However, revenue fell short of forecasts, and this is due to weaker commodity prices, and that offset some of the strong productions that the company reported.
Yeah, very interesting, Jason. I guess this should contribute to the negative earnings revisions under Golden Rule 3. But it
Hmm.
looks like financial year 25, that'd be a weak year for Woodside with earnings expected to decline considerably. What is driving this?
Well, it's a good question, Ken. It's probably based on a combination of factors. So firstly, the lower commodity prices that we saw over in FY24 is likely to persist, and this is going to continue to weigh on revenue. I mean, you've just said it earlier, Ken, Trump's rhetoric, drill, baby, drill, that's probably going to push a lot of oil onto the markets and decrease pricing. So the average realized prices the company reported during the period fell from $69 per barrel in FY23 to $64 a barrel in FY24. And the downwards trend, as I said earlier, looks like it's about to continue as well. And also, secondly, while FY25 production guidance of around 186 million to 196 million barrels is rather solid, it's relatively flat compared to the previous period. And this is not enough to offset some of the decline in commodity pricing.
Yeah, so flat production. It's not as bad as it looks, but a word of caution, though, about resource stocks and the outlook under Golden Rule 3 as well. Despite Woodside being well covered with 14 analysts, these numbers can change quite quickly because they are dependent and correlated to energy prices. And this is the reason why we don't include Woodside as a star income stock, even though that gross dividend yield is currently over 10%, isn't it, Jace?
Yeah, that's right, Ken. And also speaking about energy pricing, Ken, perhaps this is a good time to share some of our thoughts regarding the outlook for the oil price for the year ahead.
Yeah, it's very difficult to predict with any certainty, especially with the commodity pricing and the volatility. But oil prices will depend on global supply demand dynamics.
Mm.
You've got geopolitical tensions, which can affect it, and OPEC's production strategies as well. For example, the potential shifts in the US energy policies, as we've seen with Trump, such as this push for increasing domestic production, may
Mm.
continue to weigh on the oil price in the near term. Additionally, you've got softer global economic conditions, and this growing momentum towards renewable energy adoption could limit long term price growth as well.
Yeah, that's right, Ken. And moving now away from resources and onto retail. I mean, this sector's been underperforming in recent weeks. After November, retail sales figures fell short of market expectations, despite what many thought of Black Friday sales been rather strong. So
Mhm.
over the last couple of days, Myer and Premier Investments have released profit warnings, and this is due to sluggish sales during Christmas and also the Boxing Day clearance period. Can you tell us a little bit more about this, Kay?
Yeah, has certainly affected the retail sector and some of our star stocks as well. But
Hmm.
cost of living pressures have made consumers more sensitive to spending, obviously. And one of our star stocks, Wesfarmers, has actually benefited from this trend with brands like Kmart and Bunnings. They appeal to the more value-conscious consumers. However, during the week, though, Wesfarmers, they announced that they will shut down their online marketplace portal, catch.com.au, in the second half of financial year 25. And that's due to increased competition, market share losses, and also higher customer acquisition costs. So, Jace, how would this impact their group earnings going forward?
Well, it's actually a pretty surprising move on Wesfarmers' part. I mean, online retail is a highly, highly competitive space, especially with large players like Amazon. And you've also got the emergence of Chinese cheap fashion or cheap product sellers like Temu and Shine. And locally as well, we have Kogan also competing in that space. So to put it all into perspective, Wesfarmers acquired Catch for around $230 million just prior to COVID in 2019. And this was eventually integrated into a new division called One Digital in 2022. So the shutdown of Catch is disappointing. I mean, with a large company like Wesfarmers and still not being able to turn this division into a profit is rather surprising and just shows you the competitiveness in this sector. The business, however, only represents less than 1% of total revenue for Wesfarmers. So the overall impact when it is closed is rather minimal from our perspective.
Yeah, very interesting, Jason. I noticed that the announcement was viewed rather positively by many analysts, with actually a few upgrading their earnings
Hmm.
slightly in financial year 26 by up to around 1%. I guess this closure does allow a reallocation of resources towards those better performing segments for Wesfarmers. For example, the business can now focus on accelerating their retail media network, which allows those retailers to use people's shopping profile to target them with display ads near the checkout. So very interesting dynamic at play here.
Hmm. Now, moving on to the corporate calendar, the reporting season is fast approaching, and we expect ResMed to release its fourth quarter results next week.
For Under the Microscope this week, we take a closer look at the financial performance of wealth platform operators Netwealth and Hub24 following their December quarterly updates. Both companies have taken advantage of the regulatory reforms, providing financial advisors with a platform to manage their advice. But Hub24 is on a return on equity of around 13%, while Netwealth has a return on equity of over 60%. Quite outstanding there. But what's the key difference here between the two?
Yeah, the differences between those two ROEs do look a little bit stark, Kien, but the primary distinction lies within their business models. So first off, Netwealth focuses solely on platform services, while Hub24 offers platform administration, platform reporting, as well as managing class. And this is the SMF administrator it acquired in 2022. So this diversification weighs on the profitability of Hub relative to that of Netwealth.
Okay, that makes a lot more sense there, Jason. Netwealth does enjoy a net profit margin of around 30% compared to Hub's 20% as well,
Hmm.
reflecting that lower margin from Hub's additional services. And with regards to its quarterly update, so there are two key metrics that really drive profitability for these companies. The first is the growth in funds under management or under administration, and also positive market performance, isn't it, Jace?
Yeah, that's right, Ken. And both companies beat market expectations, and this should flow into positive earnings revisions over the next few days. However, Netwealth did anticipate fund flows to slow in the third quarter, and this is from seasonal trends. And management also expect costs to rise a little bit modestly this year on the back of product investments and also acquisition costs.
Yeah, that probably explains why the share price rally in Netwealth was kind of muted after the announcements. But
Hmm.
meanwhile, Hub24, they continue to win market share with their earnings growth underpinned by the growing advisors on their platform. They also have new distribution agreements and one-off migrations from EQT and also Clearview as well. Additionally, Hub is on track to exceed its funds under administration guidance of between 115 to 123 billion. So with the share price now trading at sky high levels, Jace, what should investors do here?
This is always a good problem to have, Kien. So if members are overweight the stock, it would be prudent to perhaps take some profits off the table and move some of that back into an equal weight position. However, we remain positive for both companies over the longer term. And we also note that both stocks are highly leveraged to share market returns, which could affect their funds under administration and also their management fees as well.
Yeah, just a key risk to be mindful of. But with regards to Netwealth as well, I noticed a few members were wondering why is it possible for its founders, the father and son, Michael and Matthew Hines, to hold close to a 50% stake in the business of peace, and that's on Stock Doctor there. The reason here is the holdings are represented through a family trust rather than on an individual basis. This week, one of our members raised a concern about the low equity risk premium in the market, particularly following a year of exceptionally strong returns. So the question is, what is the equity risk premium and should investors be concerned?
Well, without getting too theoretical into this, Kien, the equity risk premium represents the excess return investors expect to earn by investing in equities over risk-free assets, and this is comparing to government bonds. In other words, it also reflects the compensation for the extra risks investors take by investing in this asset class. Look, there are a number of ways to calculate the equity risk premium, but the process can be rather subjective.
That's right. But just looking and how we can compare historical trends, an easy and popular approach is to compare the corporate earnings yield, and that's in the orange on the chart on screen with government bond rates in blue, as shown. And the earnings yield is basically the inverse of the price to earnings multiple. So when the earnings yield is high relative to bonds, it does suggest that equities are cheap relative to bonds and hence more appealing and vice versa. As you can see, the yield gap between equities and bonds have not been this low since the GFC, the global financial crisis, suggesting that equities are expensive at this stage of the market cycle.
That's right, Ken. And in practice, however, there is limited correlation between a low or negative yield gap and a forward 1 year equity returns. And the reason for this is that there are many factors that can impact share market returns, and this could include growth in earnings, dividend income, money flow such as from ETFs, market events, interest rates, and also economic conditions as well.
Yeah, that's right, Jason. Just because the market does look expensive, it doesn't mean that it cannot become even more expensive this year as well. So remember, fear can keep you out the market during periods of positive returns. But with the markets, there's always an element of risk. And so it's best to focus on what you can control. And that is the risk management and the quality of stocks in your portfolio.
That's right, Ken. The key is to stay invested over the long term and also ensure that you are diversified across financially healthy and high quality businesses. Only then should your portfolio be able to generate some of the strong returns, irrespective of the market cycle.
Yeah, and that's all we have time for today. And thanks, Jace, for your insights. It's going to be very busy heating up to reporting season. So look forward to working closely with you then.
Always a pleasure, Ken.
And if you have any questions on today's episode, remember to come to our stock room next week on Tuesday as well. So make sure you sign up there to hear about our reporting season preview. Until then, we wish everyone a happy, healthy, and prosperous week ahead.